They're in candlestick form. There are 3 bars on the bullish version and 3 bars in the bearish version. And my traders are taught every single day, pick a stock. And I want you to, any stock we give them a universe of stocks. This is pick any one of the stocks. Now pick a time frame. 5-minute, hourly, daily, whatever time frame you want. Doesn't matter. Pick a time frame, and I want you to wait and practice identifying when any one of these 3 bars shows up. Now let's talk about the first set of bars. They're called elephant bars. This presentation is called the elephant walk. And I'm going to focus predominantly on this bar because of all the 13 bars, these are the 3 most important. But of all the 3 bars, this is the most important bar of all. It is the elongated, wide-range, fat, green, tall bar. And what's beautiful about this bar is that you and I can't form it. It takes billions upon billions of dollars to produce a bull elephant bar. You can take your little bit of money and buy until all of it's gone, and you won't even create a blip in an IBM or a Research in Motion or Yahoo or British Petroleum. So, whenever a bull elephant bar forms, a fat, long, taller than most of the bars to the left of it, unique in its size, that means that not only are institutions buying, they're buying at the same time. Now think about this scenario for a second. Think about this for a second. Let's assume, and I'm going to oversimplify this, but it's good. Let's assume that every stock or a particular stock had 10 institutional players that dominate 95% of the market's activity. All right, we know that you don't make markets move. Major institutions make markets move. And when they pile in, markets move up. When they pull out, markets move down. Simple. Supply and demand. But it takes institutions acting in tandem to cause something really unique to happen. So of the 10 institutions in a particular stock, each one of the 10 institutions has $1 billion to play with. So there's a pool of $10 billion. Now, if 5 of the institutions, 5 billion, is buying while 5 billion are simultaneously selling, what will your stock do? Nothing. 5 billion's buying, 5 billion selling, equilibrium. Supply and demand is equal. Your stock does nothing. But all of a sudden, one of your sellers stops selling and then moves to the buy side. Now there's 6 billion buying and 4 billion selling. All of a sudden, you know what starts to happen to the chart of this stock? You start to see a slight pickup in the number of green bars and the slight, ever so slight pickup in the size of the green bars compared to the red bars. So you know how there's some bars are green, some bars are red? Well, if there's 50% green and 50% red, then there's 65% green, right? 45%, 35% red. But then if you measure the size of the green, if the greens on average are a little taller than the reds, then that's a sign that the footprints of elephants on the buy side are bigger and slightly stronger and more potent. But wait a minute. What if of the 10 institutions, 5 were buying, 5 were selling, and all of a sudden 4 of the sellers stopped and went to the buy side? Now you have 9 billion worth of buying occurring with only 1 billion offsetting on the selling. Now all of a sudden, most of your green bars become elephant bars. Because every time the 9 group buys, it's a major event. Does this make sense? That when you have in tandem, when the institutions all agree and move to one side, it's the only way a stock can produce a bull elephant bar. That's when I want my traders joining the party. when there is total agreement between the people or the entities that count. Not total agreement amongst your relatives, your neighbors. They don't move the stock. Total agreement amongst the firms and the institutions that really count. You can't have a bull elephant bar if there's conflict amongst your institutional crowd in that stock. You can only have it if they all agree, and they all agree at the same time on the same day. And this makes this bar extraordinarily powerful. And I teach my traders that whenever a bull elephant bar forms, you buy into that bar at the end of the bar's formation. You do not wait for that bar to finish trading. If it is a daily bar, you buy into the bull elephant bar in the last 10 or 15 minutes of the trading day. If it is a 5-minute bar that you're trading, you buy into that 5-minute bar in the last 15 seconds of the bar's life. And once you buy, you put a stop under that bar's low. This is the bear version of the bull elephant bar. It opens and falls all the way to the low, but it is an elongated drop, a wider range bar than most of the bars to the left of it. And this means that elephants are stepping out of the tub. Listen, I have 6 children, and I've trained them all to trade, all right? And because I have 6 children, I have practiced taking complex trading concepts and breaking them down to a child's level. So what I teach my children, what I've taught my children about the elephant bar, I said, listen, imagine in our bathtub, the water's filled in the bathtub about halfway. Now, there's a big giant elephant that wants to get into the bathtub, but doesn't want to raise the level of the water. Is that possible? No. Once the elephant steps in, the level of the water rises. So what the elephant wants to do is ease in and make it rise so gradually that you don't detect when they are doing their most important work, accumulating. So what an elephant does is step into the tub ever so easily. Now the water starts wobbling, and then he says, shh. And then when the water settles, then another foot comes in. Boom! There's maybe a bottoming tail bar, which is the next bar. You see, elephants can't go in without producing these bars. These are the only footprints of the elephants that matter. Whenever they act, they produce a bull elephant bar or a colored bottoming tail bar or a non-colored bottoming tail bar. Those are the only 3 footprints of elephants. And every time they make a splash in the tub, one of these bars reveals their actions. And we buy into these bars toward the latter part of their formation. So, in reality, the bottoming tail bars are no different from the bull elephant bars. They're both power surges. See, first the bottoming tail bars were bear elephant bars that lost portions of their red, lost more of their red, lost almost all of their red, and then went bullish. Now, what's the difference between that power surge up to leave behind a bottoming tail and this power surge up to leave behind a lot of green? In my mind, that's green, and that's green, because they all 3 have power surges. The power surge is the level of the water in the tub that rises because an elephant just got in. Does this make sense? And so, all we're looking for is a sudden rise in the level of the water. A sudden rise leaving behind a lot of green. A sudden rise leaving behind a bottoming tail. These are the 2 signs of the level of the water rising. And they're the signs or the signals for us to act. And I teach my traders that whenever a bottoming tail bar forms, whenever a bull elephant bar forms, you put my money into every single one of those bars. When a bull elephant bar comes, put money into that bar. When a bottoming tail bar forms, put money into that one. When another bottoming tail bar forms, put money into that one. I want my money in every single one of these bars. Because if they act when these bars happen, I know I'm acting when the major entities that really matter are acting at the same time as well. Now, very quickly, this is how we buy. Once, it doesn't matter what time frame this is in. Some of you may say, Oliver, well, I trade stocks in a micro time frame, 2 minutes, 5 minutes, 1 minute. Fine. Whatever your time frame, this strategy works. All right? You get a giant bull elephant bar. If it's a 1 minute, you're buying in the last few seconds of the bar's formation of that 1 minute time frame. If it's a daily, the last 10 or 15 minutes. Why? Because we want to make sure that this is not an elephant bar in the first 2 hours of the day and loses all of its greenness by the end of the day. We want to make sure that by the end of the day, this is truly a bull elephant or a bottoming tail bar. Now, once we're in the bar, once we have bought the bar, we put a stop often under the same bar's low. So I want you to think about what this does. When you put a stop under the bar you just bought, what's the maximum number of bars you will ever lose on a trade? It's not rocket science. 1. You buy the bar, put a stop under the same bar. If you lose 1 bar. But when you win, you might win 22 bars. You might win 13 bars. You might win 8 bars. When you win, the odds are that you win many bars, but when you lose only 1 bar at a time. What if your maximum loss on every single one of your trades was limited to 1 bar? The very bar you committed to. That alone, if you walk out of this room in about an hour with that one thing that you change in your trading, I guarantee you it will change your life. I guarantee you that one thing will change your life. Lose 1 bar. I want you falling from the basement window. Big deal. I don't want you falling from the 40th floor. Simple as that. Now, here, same thing. Yes, I do short the market. In fact, I prefer a short over a long. My first instinct as a trader is to see if I can find a short first. Then if I can't find a short, it's like, all right, let's just go long then. All right? I'd much prefer, most professional traders prefer to go short. Why? Stocks in every financial instrument falls faster, harder, and further than they rise. Simple as that. Your gains are faster. But same thing here. Giant elephant bar, sell short, stop above the high. Topping tail bar, sell short, stop above the high. Sell short, stop above the high. Same technique, same tactic. Now, I want you to take a look at a few charts with me. And I'm going to ask you a series of questions. And I know in the beginning it's going to be real tough, but as we go through the charts, it's going to become easier and easier for you.